What's up, guys? Alan here with eatsleeptrade.net. I wanted to go ahead and take a second and make a lesson video for you guys on striving to find that proper entry and help you guys eliminate some of the emotions that come along with trading. Finding that proper entry is a huge part of becoming a successful trader. Proper entry allows you to define your risk, and keep it at a minimal, as well as allowing your reward to be as large as possible. And you always want to have that risk reward ratio in your favor to give you the best possibility for success. So sit tight for just a second. We'll be right back and we'll get into finding the proper entry. Alright guys, welcome back. We're taking a look at the chart here for COWN, and this here is a chart that we traded off of our watch list and are still currently have a long position in. So we're going to review this trade and why we entered where we did, and how you guys can find the proper entry for yourselves. So here, this yellow circle as well as the yellow line is going to represent the day in which we started our swing and the price that we started our swing, which was at 550. This green area up here is going to be our target price or our reward, where we expected the price to return to, which in this case was around 595, a previous resistance area that I thought the stock had a pretty good opportunity to work its way back up to, since we are in this nice strong trend and anticipating that that strong trend would continue. And our red circle here, as well as the red line, will represent our defined risk area, or where we would have placed where we placed our stop, which was right around 539. So every chart has to be read differently. There's not a chart there's not just one strategy that's going to work for every chart. But I try to base my entries off a good risk to reward ratio. And you want to do at least a 1 to 2. I really strive to find charts that are giving me a 1 to 3 or higher. So when I find a chart that offers me that 1 to 3 risk to reward ratio, I make sure that my stop can be placed low enough that the stock has room to move, so I don't get stopped out early, but not risking more than 2% of my total capital. So you can see here, this was an obvious low, and it gave us a very defined risk to that previous low. If we broke below this area, we would know that obviously the chart is not going into the direction that we wanted it to, and my idea here was to take advantage of this major sell-off or large dip that we had during this uptrend that pulled back to our 50-day simple moving average. Alright, so with that being said, starting our swing here at 550, our stop placed at 539 gave us a risk of 11 cents. Okay, so we're risking 11 cents per share on this trade. And if we hit our target price up here at 595, we have a possible reward of 45 cents. Okay, so that's the first thing that I look for. A stock that is presenting buying opportunity with a well established positive risk reward ratio, or in this case a 1 to 4 risk to reward. So once we find that positive risk to reward, we can then decide the size of our position based off not risking more than 2% of our total capital. Okay, so we never want to risk more than 2% of that total capital while having a positive risk reward ratio. So for example, let's say that you are swing trading with a $5,000 account. So you have a small account and you're very limited on the trades that you can make. Having a small account is all the more reason to pay attention to your risk to reward. This allows you, for example, to make this trade 4 times and you only need to be right one of those times in order to break even, and you're not going to be right in every trade, so you really need to have a higher reward versus what you're risking on each trade, so a single winner can make up and be profitable even if you have 1, 2, or 3 losing trades along with that winning trade. All right, so back to figuring out our position size. So our example here, we have a $5,000 account max, and risking only 2% of your $5,000 is going to allow you to risk up to $100 per trade. Okay. So let's say on this trade, we're thinking about doing a 500 share position size. So we're purchasing 500 shares, okay, at 550. So we're using close to half of our total capital here. So that'll cost $2,750 for 500 shares. And if we get stopped out, we are going to lose $55, okay, plus commissions. So for Fidelity, I'm paying $8 each way, so plus $16 in commissions, okay. So that's going to equal $71. So there's our risk. Don't forget to add in, those commission fees. They should be included in your risk. And our possible reward or outcome, if we were to hit our target price up here at $5.95, is going to give us $225 in profit. So you guys can see that even if we lost this type of a setup multiple times, we only need to win it once in order to be profitable, and that is really the key to trading, is keeping that positive risk to reward ratio whenever you're entering a trade. Keeping your risk below 2% of your total capital while having that positive risk to reward ratio will give you the best chances of becoming successful as a trader. Alright guys, that's going to wrap it up for this video. If you have any questions or suggestions, please leave them in the comments below. Don't forget to like and subscribe for future videos. Also, check out our website, eatsleeptrade.net. From there, you can follow me on Twitter as well as like our Facebook page to get live updates on all the stocks that we are watching and trading. Alright guys, thanks for watching, and we'll see you in the next video.